Hello, everybody, and welcome. As I'm sure we are all aware, we are in the midst of an historic crash as far as the market goes. I was waiting till now, Sunday afternoon, to do my little video because I wanted to see what would happen when the market opened and see where we're at. Well, I found out my answer right away. So, this is actually the futures market. If you look up here, this says \ES. This is what they call the S&P 500 futures. And the futures open now on a Sunday afternoon. They run almost 24 hours a day. They're closed for the weekend. Not important. You can look it up to see when their hours are. But they just opened. And what happens is in the futures market, what they call the overnight market, and this is it right here, if the overnight market drops more than 5% overnight, they lock the market, essentially close it. You've probably heard it in the last few days or weeks that they've locked the market or closed it for a certain amount of time. Well, this has already happened. So tonight they just opened and they're already closed for the night because they're already down another 5%. So not good news for the morning. Who knows what tomorrow brings? But as far as right now, you can see where we're at from where we started. Let me just go up here. From the top of the crash to now where we're at on Sunday evening, you can see we're down 36% in 3 weeks, in just about a month. Holy smokes. And at this point, who knows how much farther this can go down. I actually went back and looked at 2008 to see how bad it did get. And I looked and it looked like we're down about at the worst possible lowest point from the highest to the lowest, we're down about 60%. So we may not even be close to halfway there or roughly halfway there to how bad this can get. Assuming this is as bad as 2008, it could be worse. So not good news. Nobody wants the market to crash. Doesn't help us as traders either. When things move this far, this fast, there's really nothing you can do in the option market besides take a pure guess and hope for the best. So what are we going to trade? What can we do in this market? So I've looked around and I kind of wanted to see like where we're at in a lot of areas. So I'm going to start. I'm going to go right here to the oil market, and this is oil futures, right? Same thing as before. They're open at different hours than the regular market. \CL is crude oil market in the futures, and you can see we're at pretty much the low we've been at. Right now we're at 2155. It got as low as 2052 the other day, but essentially we're at lows. So I kind of wanted to look back and see how low is this in the grand scheme of things, right? Like, when's the last time we were at a level of oil prices at $20 a barrel or however they priced this thing? So I went back 20 years on this platform, and you can see right here, here's where we're at, right? 2146. Well, turns out the last time we were at this level was way back here in 2002, right? Right here is where we're at. This is 2002. So it's been 18 years since we've been at this level for oil. Okay, even in this crazy market with the market collapsing, my personal assumption is oil has to be worth something sometime, right? I mean, oil is not going to go to zero. It always has some value. And if we're down to an 18-year level, I figure, yes, we can absolutely go down from here, but I'm guessing over time we have a much better chance of going up. I don't know when that is. It could go down for another 6 months or a year, but who knows? We have to make some kind of assumption. So we're going to do something a little different this time. We're going to go to USO, and USO is essentially an ETF for oil. You can see here it says United States Oil Fund. So if you wanted to buy oil, you can use USO as kind of a replacement for buying oil. So let's go back, not to a 20-year chart. Let's bring this back to 6 months so we can see the chart itself. And you can see we're at all-time lows. Volatility is at super highs. So what are we going to do? We're going to do something that we don't usually do because the stock is so low. And my assumption is that oil will stay here, be roughly here. Maybe it'll go down a bit more, but I don't know how much more it can go down. That being said, who knows what can happen in this crazy world. But we're going to do something a little different. So in this case, I'm going to look, and you've seen I've been moving around duration dates and things because in this market, ups and downs are so extreme. The 45-day usual duration window is almost pointless. We kind of are making up our own rules as we go along because this is unlike any other time in history, so we can make up our own rules, and they may be right or wrong, but who knows, right? We're going to just try some different things. So what I'm going to do here is I'm going to open it up, just do a couple strikes. So this is something I don't usually do, which is sell naked puts. But because this stock has gotten so low, the risk reward for selling a naked put and essentially having the potential to be put stock, 100 shares of stock, is so minimal in my eyes. If this is too big a trade for you, then don't do it. But in my eyes, the risk reward is worth it. If I get stuck with the stock, I'm willing to hang on to it at this point. So I'm going to open up two option cycles because they're about twice the number of days. The monthly cycles, because they're the most liquid, you can see this one says 26 and this one says 54. So it's essentially twice as much. So I want to see like what kind of premium am I getting? I get twice as much premium for doing this. And when we sell puts, we always sell a put that's below the stock price. Well, in this case, we can't go too far down. So we'll just look to go to one below the stock price as of right now, which would be the $4 put. And you can see right now we're collecting roughly 50 cents. But this is going to be way down tomorrow. So this could be closer to these numbers, because if we were looking at where we're at, it could go up to like 75 or 90 cents. Who knows? Depends when the market opens as well. It may recover by tomorrow morning. And if I look twice as far out, 54 days, you can see for the same $4 put, I only get 70 cents. So I can get 50 cents here for 26 days or 70 cents for 54 days, twice as much. In my eyes, it doesn't make it worth it. Right? For an extra 20 cents, I'd rather roll the dice now. I can always do something they call roll forward or just get put the stock. So what happens? Let's just close this. What happens if I sell a $4 put? And it's selling naked puts is an advanced strategy, but in this case, again, because the stock is so small, the risk reward is not too bad. So I'm going to explain how it all works real quick, and that way you can make the decision whether you want to take this risk as well. So what happens is, right now, if we sell the $4 put, let's just say right now, it'll be more tomorrow, but let's just say it's for 50 cents. What does that mean? Well, in 26 days, if the stock expires above $4, I will keep all $50 I sold this put for. But let's say the stock tanks, and let's say it goes all the way down to $3. What happens in 26 days? If I don't roll this put out, and that's a complicated process, I'm not going to explain it here because it's an advanced strategy, but let's just say I keep this put. What happens? Well, I sold the $4 put. I still keep the 50 cents I sold it for. So what happens is, when I get put 100 shares, so if the stock closes below $4 in 26 days, so in 26 days, if the stock price right here is less than $4, I will get put 100 shares of stock. They will force me to buy 100 shares of stock, but my actual purchase price will be $3.50. Because again, I sold the 4 put, I still keep my 50 cents, my what they call new cost basis. Even though your platform will say you bought the shares at $4, it doesn't include the fact that you've kept that 50 cents. So I actually have a cost basis on 100 shares of stock of $3.50. So worst case scenario, what does that mean? Well, $3.50 per share, they will make me buy 100 shares of it. So it's times 100 shares, means this could potentially cost me $350 in my account. But remember, I own the shares, so I haven't lost $350. I'm buying 100 shares. It's going to charge me $350. I'm just essentially buying 100 shares of stock at $3.50 each. So if you don't have this kind of money in your account, or you don't want to take this kind of risk, that's the amount of risk you have in this trade. When all is said and done in 26 days, the most you have at risk is $350, and that's assuming that the stock goes to zero. And I personally don't see oil going to zero, but again, who knows, right? So that's what we're going to do tomorrow morning. When the stock opens up, whatever this price is, we're going to sell the put just below it. Looks like it's going to be the $4 put. We're going to collect what we're going to collect. And if we're happy with that number, meaning if I take the put price, subtract out the credit, if I'm happy with this number, if I'm comfortable with this potential number hitting my account for 100 shares of stock, then I will make this trade in the morning. So that's our trade for tomorrow morning, Monday morning.